Central banks are turning more hawkish just as the AI boom accelerates and geopolitical risks flare, yet equities are rallying and volatility is slipping back toward the mid-teens. You are watching vTalkInsight, Equity Pulse Daily for July 10, 2026, where we connect that tension between policy, profits, and positioning to what is actually driving equity performance beneath the index level. The latest Federal Reserve minutes landed with a distinctly hawkish tone, and the nuance matters for equities. Several policymakers argued there was already a case to hike in June, and the committee now describes recent cost shocks, from tariffs to energy, as reasons to stay reactive and data-driven rather than patient. The minutes make clear there is a strong consensus to raise rates again if inflation remains elevated, regardless of whether the source is energy, wages, or AI-driven infrastructure demand. Markets are only pricing roughly a 1 in 4 chance of a hike at the very next meeting, but expectations for the next move have been pulled forward into the autumn, and cuts for this year have effectively been priced out. Outside the U.S., the European Central Bank is debating further tightening even as Eurozone purchasing managers' indices have been contracting for months, while in the UK, 5-year inflation break-evens sitting above 3% underscore credibility challenges for the Bank of England. German 10-year yields have risen for 9 straight sessions, helped by earlier oil price spikes and a rebuilding of term premium, and commentary points to rising long and treasury yields over coming quarters as higher issuance and persistent inflation reprice duration risk. What stands out is how relaxed equities look against that backdrop. The S&P 500 gained about 0.8% in the latest session. The VIX sits back in the mid-teens, and yet bond equity correlations are shifting as supply shocks and larger sovereign and corporate borrowing needs erode the traditional hedging role of long-duration bonds. Dollar positioning has turned sharply net long without the index yet retesting prior highs, leaving room for further currency strength that could tighten financial conditions for overseas earners. At the same time, geopolitical risk in energy markets has moved from theoretical to tangible. Traffic through the Strait of Hormuz has slowed to a near standstill after Iranian attacks on shipping and renewed U.S. strikes, with insurers hiking premiums and shipowners pulling back, disrupting not only crude flows but also fertilizers and other key cargoes. Despite that, Brent crude is actually down around 1% on the day, and earlier price spikes have partially reversed as markets assume energy infrastructure will stay untouched and that regional conflict will remain contained. Yet several scenarios being discussed highlight that any escalation into attacks on Gulf production or export facilities could push oil quickly above $100 a barrel, with global LNG and natural gas prices staying volatile as long as the route remains vulnerable. European bond yields have already shown how sensitive they are, jumping when oil surged and retracing as it eased, and forward Fed hike expectations have been brought forward in part because of these renewed energy and transport shocks. Commentary also flags that fertilizer exports through Hormuz are being disrupted, keeping fertilizer prices well above pre-crisis norms and embedding a higher baseline for food inflation. For equities, that mix tends to support energy producers and defense while pressuring consumer staples and discretionary names that struggle to pass on higher input costs. Artificial intelligence has shifted from being viewed as a deflationary technology story to an explicit macro inflation driver in the Fed's narrative. The minutes highlight AI infrastructure build-out as raising prices for advanced chips and electricity, and heavy AI-related corporate issuance, such as Amazon's latest bond deal, is contributing to upward pressure on market rates as investors demand higher new issue premiums. On the micro side, the growth assumptions embedded in AI-sensitive equities are striking. Analysts expect roughly 31% annualized earnings growth over the next 3 quarters, the highest in about 50 years, even as data center growth has already slowed from doubling each year to closer to 15%. Forecasts that hyperscalers can sustain AI revenues growing above 100% annually for 5 years, and that $5 to $10 trillion of AI capex will translate into commensurate new revenue, are being described as historically implausible at this scale. Commentary increasingly describes the AI complex as showing classic bubble features, overinvestment, leverage, and parabolic price action, particularly in semiconductors where options and leveraged products now sit at their most extreme long to short ratio since these tools became popular. At the same time, recent pullbacks of 15 to 20% in chip names and mining stocks suggest some excess has already been wrung out, even as the structural AI story remains intact. Credit markets are reinforcing that message of enthusiasm with guardrails. Investor appetite for AI-related credit remains strong, with tight spreads and talk that high-yield debt yielding around 7% is financing parts of the AI supply chain and data center build-out with only about one-third of equity-like volatility. But heavy issuance is also creating more competition for capital, and corporates such as Amazon are having to pay up to tap that demand, which feeds back into the broader rate environment. Beneath the macro noise, equity internals are telling their own story. U.S. equities just staged a strong rebound led by technology and semiconductor stocks, with the Nasdaq outperforming and more than 300 S&P 500 constituents closing higher, even as bond yields stayed near their yearly peaks. The Philadelphia Semiconductor Index rose about 3%, acting as a key driver for the move. SK Hynix has become a focal point for this renewed enthusiasm. Its upcoming U.S. listing is more than 7 times oversubscribed, amounting to roughly $25 billion of American depository receipts, despite a 17% drop in the local share price since the deal was announced, and heavy foreign selling in Korean tech. SK Hynix trades at a notable valuation discount to Micron, with forward price-to-earnings multiples around 6 times versus 8 times, and the U.S. listing is expected to help narrow that gap. Fundamentals in memory look very different from a traditional short cycle. Supply is unlikely to fully catch up with demand until well into the next decade because fab buildouts are slow and capital-intensive, and revenue forecasts for memory producers like SK Hynix point to unprecedented top-line growth from about $12 billion to over $55 billion within a year. Despite that, memory stocks still trade at historically low multiples, prompting talk of a potential structural re-rating if investors conclude this is no longer just a cyclical upswing. The broader AI supply chain is also widening out. U.S. public markets are expanding their semiconductor ecosystem, with new listings and exchange-traded funds giving investors exposure beyond dominant names like NVIDIA, and IPO activity has picked up across semis, technology, and even industrials tied to AI infrastructure. Companies such as Broadcom and Marvell are seen as well-placed as custom accelerators gain traction, while optical transceiver firms like Coherent and Lumentum, the latter up more than 118% year-to-date, are viewed as key beneficiaries of the shift toward co-packaged optics in next-generation data centers. Outside the AI narrative, sector-level signals paint a picture of an uneven real economy. PepsiCo's latest update shows North America foods still struggling, with organic growth in the low single digits, flat volumes despite price cuts of up to 15% in some brands, and management pointing to weak consumer sentiment and higher gas prices as headwinds. Consumer packaged goods more broadly are finding it harder to push through cost inflation without sacrificing volume or margins. Yet there are bright spots on the consumer side. Levi's is seeing double-digit growth in its women's segment and in the Beyond Yoga brand, helped by less reliance on heavy promotions, while Aritzia has beaten revenue expectations and guided to continued net revenue growth. U.S. outlet mall traffic is up this summer on the back of domestic tourism and major events, and full-service airlines such as Delta are benefiting from robust premium and corporate demand, with industry capacity roughly flat and the collapse of Spirit Airlines contributing to structurally higher fares. In autos, stress is building. Volkswagen is weighing a restructuring that could involve up to 100,000 job cuts and the closure of 4 German plants, as shrinking demand, high input costs, and fierce competition from Chinese electric vehicle manufacturers squeeze margins across European carmakers. Porsche has reported its weakest first-half sales in 6 years amid changes to U.S. tax incentives, underscoring how policy shifts can hit even premium brands. By contrast, defense is in expansion mode. European deals, including Deutze's acquisition of FFG and a separate €1.6 billion engine maker transaction, highlight both vertical and horizontal consolidation as companies race to scale production and secure supply chains in response to higher defense budgets and ongoing geopolitical tensions. In healthcare, Ionis Pharmaceuticals and AstraZeneca suffered a setback when their jointly developed gene silencer drug failed a trial, knocking about 15% off Ionis's value, but the affected indication is relatively niche and is not expected to derail AstraZeneca's broader portfolio, which helps explain why the sector as a whole still trades at a discount despite its defensive profile and potential to benefit from AI-enabled research. Putting it all together, equities are threading a narrow path between a more hawkish Federal Reserve, persistent energy and geopolitical shocks, and an AI boom that is simultaneously lifting earnings expectations and stoking inflation and bubble concerns. Index-level resilience, helped by semiconductors, IPOs, and selected consumer and travel names, masks rising dispersion across sectors, stretched positioning among households and mutual funds, and a bond-equity relationship that offers less of a cushion if rates push higher from here. Over the coming weeks, the key signals to watch will be inflation and wage data that shape central bank reaction functions, developments in the Strait of Hormuz and European energy balances, and, crucially, second quarter earnings and guidance from hyperscalers, chipmakers, and cyclicals that will test whether today's growth assumptions are sustainable. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.